Welcome to video 15C on double taxation. Again, not a new topic. Chapter 15 is a bit of an overview. Some of these things we've seen before. So double taxation, income generated by flow-through entities is taxed only once. Income of C corporations is taxed twice. Flow-through entity owners pay tax on their share of income as if they'd earned it themselves, whereas corporations pay first level of tax on their taxable income at the corporate marginal rate, which is for corporations now 21%. Then shareholders are subject to double taxation when that income is passed through to them, and they vary anywhere from 12 to 37%. So the interesting thing is, after-tax earnings distributed by a corporation to individual shareholders, that second tax is actually going to be at 0, 15, or 20%, depending on the taxpayer's income level. And there's a 3.8% net investment tax that we really don't deal with in this class. So let's assume that Cho did some income projections to help her determine the taxable income from her business. And she makes the following assumptions. So the Leaky Cauldron Corp is going to earn taxable income of $350,000. I shouldn't call it Corp, it's just her business. The Leaky Cauldron will distribute all of its after-tax earnings annually. Its corporation has a dividend. Her ordinary marginal tax rate is 35%, and we're going to assume that she is in the net investment income tax. So her dividend tax rate is 18.8%. That's the 15% plus the 3.8% net investment income tax. And we need to assume that Cho's QBI deduction, when she's eligible for that, is not limited. So given these assumptions, if Cho goes forward and organizes the Leaky Cauldron as a corporation, what would be the overall tax rate on the Leaky Cauldron's income? So that's both the corporate and shareholder level tax. So let's start in the column on the left, a corporation that distributes all of its income. So again, the pre-tax income is $350,000. 21% tax is $73,500. That leaves $276,500 available for distribution. She's going to pay 18.8% or $51,982. Oh, excuse me, $51,982. I'm boring myself. Leaving after-tax cash flow of $224,518. Her total tax rate, part of which is at the entity level, part of which is at the shareholder level, is 35.85%. Okay, now let's look at one that distributes none of its income. So if we have a corporation that distributes no income at all, then there's only the entity level tax of $73,500. That would leave $276,500 available for distribution, but none of that is going to be distributed. It's all going to be reinvested. And so this is where, as we spoke about in the last module, this is where the share price would presumably increase, and ultimately the shareholder would sell their shares before they would trigger any gain recognition or income recognition. So if we do the same thing, except it's a flow-through that distributes all its income. So again, the flow-through has, this is the third column, the flow-through has no entity level tax. So all $350,000 is available for distribution. The tax on the distribution is at ordinary rates. So we said that Cho had a 35% rate, but because there's a 20% QBI deduction, you can take 80% of the rate. That's the same thing. Mathematically, that works out. I think that's the transitive property of mathematics. In any event, the after-tax cash flow after her $98,000 tax, $252,000, making the total tax rate 28%. So if a flow-through distributes none of its income, we know from the last video, absolutely nothing changes. That income is all still taxed at the shareholder level or at the owner level because they're not shareholders. And as a result, there's a 28% tax rate. So if we look across here, if we're going to distribute the income, the flow-through probably makes sense. If we're going to try to leave the retained earnings inside the corporation, then a corporation makes sense. Okay, so now let's assume that Cho did some income projections, and she's TLC is gonna earn $350,000, but in order to help mitigate some of that corporate level tax, Cho is going to pay herself $100,000 in rent each year. So rather than have the business own the Leaky Cauldron building, she's going to own it herself. And then she's going to charge her corporation rent. TLC is going to distribute its after-tax earnings to the extent the corporation has a dividend, and the tax rates are the same. Okay. So let's look at the first column, a corporation that pays no rent. That looks just like the one we did a couple slides ago. You can see the after-tax cash flows, $224,518, with a total tax rate of just about 36%. So if that corporation instead pays rent of $100,000, so now you can see on the rent line, we've got a $100,000 deduction. That reduces that entity's income down to $250,000. Thus, that lowers the entity level tax to only $52,500. Again, that's 21%. That leaves $197,500 available for distribution. So if you look at the tax on the distribution amount, that is the dividend, that's at the 18.8% rate. She also receives rent. That rent is ordinary income. And again, it would be taxed at 35%, but due to the QBI deduction, it's only 28%. That leaves after-tax cash flows of $232,370, or just above 33.5%. So you can see that by shifting some of the income out of the double taxation, even though it's taxed at the higher rate, 28% post-QBI deduction as opposed to 18.8%, she still comes out ahead. So why don't we bump it up? Why don't we have the corporation pay a greater amount of rent? So now in the third column, it's paying $200,000 of rent. That only leaves $150,000 of income. The entity level tax is down to $31,500. That leaves $118,500 for the distribution. The other $200,000 is coming through rent. So the 18.8% tax on the distribution is just over $22,000. The 28% tax on $200,000 of rent is $56,000. So her after-tax cash flows are up to $240,222, and her rate is down to only 31.36. So you can see the temptation on the part of taxpayers is to try to increase rent, try to increase deductions out of the corporation that, of course, flow through to the owners themselves, because to pay rent to someone else doesn't make any sense. That's just money gone. Okay, so a little bit more about these after-tax earnings that are distributed. So for a corporate shareholder, those are typically dividends. If it's a corporate shareholder, those dividends are subject to corporate ordinary rates, meaning there's no special rate, there's no preferred rate if a corporation is receiving the dividends. But corporations take something called a dividends received deduction. And we're going to spend some more time on that in the next few videos. But the DRD percentages are 50, 65, or 100%, depending on how much of that corporation is owned by the parent. And again, we'll walk through exactly how that works. So institutional shareholders are pension plans, for example. And they don't even pay a shareholder level tax on dividends because pensions generally earn income tax free. And then you have other tax exempt and foreign shareholders. They're also exempt from the tax on investment income, including dividend income. So sometimes the corporate shareholder or the double layer of tax gets eliminated because there is no shareholder level tax. Okay, so what are these strategies? We've already talked about some of these. You could pay salaries to the shareholders. You could pay fringe benefits to the shareholders. You can pay rent to the shareholders. Or you could have the shareholders loan the corporation money and have interest paid out to the shareholders on the loan. So strategies for reducing the shareholder level tax is to retain those earnings rather than distribute them. But we learned in the last video that there are a couple of taxes that are there to try to prevent that from happening. And then the other thing is you can just hold on to the stock and then sell it once the gain has appreciated over a fairly healthy length of time. That brings us to the end of video 15C and the end of chapter 15. Thanks for watching.